Hi everyone, Professor Christensen here. In this video we're going to take a look at Chapter 8, which is all about current liabilities. So our learning objectives for this chapter, we're going to be able to distinguish between current and long-term liabilities, which you kind of have an idea about already, right? We're going to look at accounts, accounting for notes payable and for interest expense related to the notes. This is very much like what we did previously with receivables. We're going to take a look at employee and employer payroll liabilities, and then look at a couple of other current liabilities as well as some ratios that we use to analyze current liabilities. All right, so first let's take a look at distinguishing between current and long-term liabilities. So you probably remember from way back in the class that we had distinguished current liabilities as those that need to be paid within a year, right? And then long-term are after a year. Now, we're going to add something to that. We're going to say paid within a year or the operating cycle, whichever is longer. Now, what's the operating cycle? The operating cycle is you start with cash, and then you buy inventory. So in here we would say buy, right? We buy inventory. And then we have the inventory, and then hopefully, of course, we sell the inventory. And when we sell the inventory, we get a receivable. And then the receivable gets collected and turns back into cash. And this happens over and over and over again. For most companies, this happens many, many times in 1 year. But it's possible that the operating cycle could be longer than a year. Now, think for a minute, can you think of any company that might take longer than a year to do this, to get cash, either provide goods or services, buy the inventory, get the receivable, and collect the cash again? Well, if you said, let's say, possibly a builder that's building a very large building, or maybe a winery or a company that makes whiskey, a distillery, right? Because those things have to age for a while. In that case, it could be that your operating cycle is longer. But for our purposes, most of the time we're going to say current liabilities within 1 year, long-term liabilities more than 1 year, all right, for what the due date is. All right, so a very common current liability is note payable or notes payable. So a note payable is simply a note, and if you think of like what a check looks like, right, is say you're going to pay somebody a certain amount of money, it has a date on it. The difference with the note payable is that it has a due date when the money is due, and also it has interest associated with it. All right, so basically the borrower is promising to repay the money back on a certain date with interest. Now, interest is recorded. We want the interest to be associated with the period of time we want it to be recorded in the period of time that it's associated with. So because for a matching principle. So if you're borrowed money this year, then you want the interest associated with that borrowing to be recorded this year, even if you don't pay that interest until next year. Okay, so from a practical standpoint, what that means is either you're not going to record interest every day, of course. So the interest, remember, could be an adjusting entry. So if a financial statement date comes before you repay your note, then you accrue interest at the end of the year. So it's either accruing it at the end of the year, or say it's only a 1 month note, then you're just going to record the interest when you pay it back. All right, so practically speaking, it's usually either when the note is repaid or when you're preparing financial statements. Now, the interest calculation is equal to the principal or the amount borrowed times the interest rate. Those two are fairly easy, times the fraction of a year. Now, remember, this is fraction of a year. So the time thing, if you're having trouble with the note, the time thing is always the tricky thing. So think about what period of time are you recording the interest for? And so that's sometimes tricky because it's hard to figure that out. So watch the time very carefully. There is a separate video covering this, and that video is going to walk you through your lab. So definitely take a look at that. Okay, there is a link to that in your guided notes. All right, so next thing we're going to talk about is employee and employer payroll liabilities. Now, if you have ever held a job, and even if you haven't, you're probably familiar with some of these terms. So a salary versus wages. Salary means that you're paid an annual amount, and often it doesn't matter how many hours you work, you still get the same salary. So if you work 40 hours in a week or 50 hours, you still get the same salary. Wages tend to be hourly. So wages are going to be, you get paid a certain amount per hour, and then if you work more hours, then you get paid more, right? And then you also get overtime if you work over 40 hours in a week, and that's usually a time and a half, right? So salary versus wages. Now, gross pay is that imaginary number that you wish you actually ever saw. So say you make $50,000 a year, that is your gross pay. Will you ever see $50,000? You will not. And the reason is deductions, right? So the amount that you see when you get your paycheck is the net pay. And the net pay is equal to gross pay minus the deductions. Now, what kinds of deductions are there? Well, you might have to pay, you're going to have income taxes withheld, and that could be federal and state, and it could even be city if you happen to be in like New York City or Yonkers, a place where there is a city tax. You might have 3 different kinds of taxes. Other kinds of deductions are, well, there's FICA, which is the Medicare and Social Security tax is withheld, so those are not optional. And then there are all kinds of other optional things that might be withheld from your paycheck, things like union dues, contributions to your health plan premiums, 401k contributions, savings, a bunch of other things might be deducted. So when you take your gross pay, that imaginary $50,000, subtract all of those deductions, you get back down to that sad amount of money that you take home. Not always sad, but you get the idea. Deductions reduce your gross pay and bring it down to net pay, which is also called take-home pay. All right, so employees and in your deductions are pay these things, and we just mentioned these: the federal and state income tax, Social Security and Medicare, contributions for health, and then contributions to things like 401k. So those are the things that the employee pays, so they come out of their paycheck. But the employer is also responsible for paying some things. So the employer, oh, hold on, I forgot. Before I get to employer, let's talk about how we journalize that, then we'll look at employer, all right? So what does a journal entry look like to record payroll? So the gross pay is a debit to salaries expense. So the employees here earned $100,000 during this pay period. That's their gross pay. That's that imaginary number, remember? Then we credit payables for all of the withholdings. Why? They were taken out of the paychecks by the company. So the company took, for example, your income taxes, and they have to send them to the government. It's not the company's money, right? It's really technically your money, but the money's being paid to the government, or it's being paid to, there could be other places that it's being paid, right? So we have salaries expenses being debited for gross pay. These are payables. They're current payables, so you're going to have to pay your income taxes to the government, FICA, which is the Social Security and Medicare, and then the net pay is credited to salaries payable, and that's the amount of money that will actually get paid out to the employees. All right. Now let's take a look at employers. All right, so the employers pay federal and state unemployment tax. So the employers have to contribute money to the unemployment fund so that if people have an unemployment situation, they get paid unemployment, right? So the companies contribute the money for that unemployment. The employers also have to match the same amount of the FICA, the Social Security and Medicare, that's taken out of your pay. So remember this journal entry. So they took out $76.50 from their employees. They also have to pay $76.50. And then often the employer will contribute to health plan most of the time employees are not paying all of the healthcare premiums. The employer pays part of that. And a lot of times the employer will match part of your 401k deposits. So let's look at what happens with the employer's journal entry. So your debit here is simply the total of all your credits, all right? And your credits are to the payables that the company has. So in this case, FICA tax, remember I said it's a match. So the company has to pay the FICA tax. The company is paying unemployment taxes. And then add those two up and you have a debit of $14,000, which is your debit to payroll tax expense. So this is the company's expense. So these things that the employer pays, the company pays, are considered an expense. Okay? So that's the basics of employee, journal entries. You have to remember a lot of companies outsource this because it is very, very complicated. If you think about all the different employees, and it can be very, very complicated. But if you understand this simplified version, you have the main gist of it. Okay? All right, so next up is a couple of other current liabilities. We're going to talk about deferred revenue and then sales taxes payable. So deferred revenue, remember, is money that has been received from customers before goods or services were provided. So when you're recording deferred revenue, it's a credit balance account because remember it's a liability. You're debiting cash, right? The only way you can have a deferred revenue is you must have gotten cash. So you're debiting cash, crediting the deferred revenue, and then eventually the revenue gets earned. And when the revenue gets earned, it comes out of deferred revenue and goes into either service or sales revenue. Okay. Now sales taxes payable. Sales taxes payable that's money that was collected from your customers, but you don't own that money, right? It's just like the money that's taken out of your paycheck. The company gets sales taxes, but the sales taxes don't belong to them. The sales taxes belong to the government, so they have a liability called sales taxes payable. So there are some examples in your guided notes. Go ahead and take a look at the deferred revenue examples and the sales tax examples. All right. All right. Finally, we're going to talk about a couple of ratios, and we're going to look at the current ratio, which is simply the total of all your current assets divided by all of your current liabilities. And it gives you a number, say 2 to 1. Say your current assets are $100,000 and your current liabilities are $50,000. So you divide 100,000 by 50,000 and you get 2. So it's 2 to 1. So what that tells you is that the company has $2 of current assets for every $1 of current liabilities. Okay? And then now the one thing I want to remind you about with current ratio and acid test ratio, current ratio even more, you always have to, I know students like to have simple answers. So generally speaking, the higher these ratios are, the better. But you have to be careful with this because you always want to look at the numbers behind the ratios. For example, if your accounts receivable are going up, that might not be a good thing. That might mean that your receivables aren't being collected, right? And there's something wrong there. Now, if your sales are going up and your receivables are going up, that might be okay. But you understand that just because your current assets are going up, that doesn't necessarily mean that it's a good thing. The other thing is, what about if your inventories are going up? Well, if your inventories are going up, that's a current asset. That's going to make your current ratio go up. But what if you have a bunch of obsolete inventory? Or what if you're not selling your stuff, right? That could be a bad thing. So always think about the numbers behind the ratios. So the acid test ratio is a more precise way of looking at liquidity because it only includes your most liquid assets, cash, short-term investments, that would be like you own stock in another company that you're going to sell soon, and accounts receivable divided by your current liabilities. Again, the higher the better. And what that's telling you is, can you pay your current liabilities with your most liquid assets? You don't have to worry about selling inventory or other things. All right, so those are your two ratios that we're going to take a look at in this chapter. Okay, so that's what we have for Chapter 8. Do go back and take a look at the Notes Payable video, which is going to help you with your lab. That's the same problem that's in your lab. I think there's one number that's a little different that you're going to have to change when you actually do your lab, but definitely use that video that will help you with your lab. Okay? All right, see you next time.